Today's episode is brought to you by Public.com, an investing platform which you'll be hearing more about later on in the show. But for now, let's get into today's interview. I am joined once again by Lyn Alden of Lyn Alden Investment Strategy. Lyn, welcome back to Forward Guidance. How are you doing?
Pretty good. Thanks for having me back. It's been a crazy week.
It really has. We're recording the afternoon of Wednesday, March 15th, 5 days after the fall of Silicon Valley Bank. And then we had the Signature Bank fall on Sunday, being taken over by the FDIC, some emergency packages being rolled out by the FDIC, Fed, Treasury. I want to get into all of it, Lyn. But first, let's start off. When you have these bank problems, what is the cause of it and how concerned should people be about them?
So each banking crisis is different, and a lot of people, I think, fight the last war. So a lot of people, when they hear banking crisis, they immediately think of 2008, whereas that was largely a credit event. Basically, banks made a lot of bad loans that were defaulting. In this context, it's not that bad loans are defaulting; it's that actually very, very safe securities were bought at high prices, low yields. And as we've entered a higher inflation, higher interest rate regime, many of them have unrealized losses, which for the most part, for like a big bank is fine because if you hold to maturity, you're going to get your money back. But if their deposit base is skittish because say they have a high percentage of not insured large business accounts, they can pull funding quickly and make a bank sell those those securities at a loss. And for Silicon Valley Bank's case, their losses, were exceeding their capital because they managed risk poorly. But across the broader space, generally, when they increased rates this quickly, it put a lot of pressure on the existing asset bases of pretty much all banks, but especially skewing towards the small and the medium-sized banks, because when you have a liquidity problem in the banking system, it's not like liquidity can really leave the whole banking system quickly, but it can leave in any individual bank quickly, and so it can skew towards the larger banks and leave some of those small and medium sized ones dry.
So there's three things for banks. There's solvency, liquidity, and then profitability. Solvency is, do banks have more in assets than they have in liabilities? If they don't, that's a problem. Liability is the ease with which people can get money in and out of a bank. Banks can convert assets into other sorts of assets. And then profitability is the bank making money? Is it earning enough on its assets to pay people in deposits and keep the deposits in there? Of those three different metrics by which, let's say, you can sort of judge a bank's health and future, which are you concerned about?
I think for most banks, solvency is less of a problem than the other two. And that's what makes it different in 2008. Liquidity and profitability kind of go hand in hand because if a bank wants to keep its deposits, one, depositors have to have confidence in it. But then also if they want to avoid the long kind of drag of capital leaving them and going towards things like money markets, they have to increase their deposit rates. And that's where you enter the profitability problem. And so I would say for the long tail of small and medium banks, I would say it's both a liquidity problem and a profitability problem. Because those, one of the ways they can try to shore up their liquidity is by sacrificing some of their profitability. For larger banks, it's less of a liquidity issue because they have, very, very large and liquid securities books, diversified deposit base, and they now have access to the Fed's facility as well. So for them, it just becomes, I think, a potential question of profitability. If some of those maybe large regionals have to raise their deposit rates more, I think to the extent that it becomes a profitability problem will in large part depend on the Fed. If they really push forward with tightening, that can continue to suck money towards things like money markets and away from bank deposits, and then that therefore requires banks to raise their deposit rates at a quicker rate. Whereas if the Fed eases off, that gives banks more of a reprieve.
Because if the Fed keeps raising rates, the differential between what you can earn in a money market and what you can earn with a bank account, that will widen, so suck money out of banks. So there's an element of panic. How concerned do you think that this issue of panic is, where even if the regional banks are fine, their solvency is fine, but people fear feeds on itself? as we have seen today with with Credit Suisse.
I think that's a big concern, but I also think even if you're, basically even from a rational perspective, at this point, if you're a business, for example, if you're if you're operating a bank account that's above the insurance limit, you generally do want to take precautious actions because you can't assume necessarily that FDIC is going to back every deposit, right? That that's it's something that at this stage seems somewhat likely, but you can't base business decisions on that assumption. So you have to assume a somewhat adversarial mindset and say, okay, we want to either diversify accounts, use bigger accounts, sweep extra funds into money markets. You want to take defensive actions, and none of that is particularly good for the small and the medium-sized banks. And so, I would obviously advise people against making panic decisions or emotional decisions, but you do want to take rational defensive decisions. And based on the current incentive structure they've set up, that inclined people towards larger banks and towards money markets. There's also, I mean, there are some like fintech companies that can kind of like manage your money for you. So it kind of like puts it out into multiple other banks. So you can kind of like have a large amount that is like FDIC insured because it's spread out. There are solutions like that that could benefit. But overall, it's not a great environment for small banks to operate in, and small banks because they're less liquid on average. They have larger loan books and less securities books. They have less use out of that new Fed facility compared to say the very large regionals, for example. So I would continue to be somewhat concerned about small bank profitability, and even if deposits are insured, there's still disruption if you have say one bank account with a small bank and then they have liquidity problems. Um, Obviously that can impair your business, even if it's just on a temporary basis. And so there are a lot of incentives for businesses to gravitate towards what they view as the most stable banks.
So, Lyn, that old adage that I've heard many times, I've said it myself many times: rising rates are good for banks, high interest rates are good for banks. Is it true?
I think we have to separate the rate versus getting there. Because on average, if you have if you have like an artificially low rate, it's really hard for banks to make a profit because lending decisions don't really make sense. There's a very narrow spread, whereas a more normalized rate environment is a better environment for banks. But if you go from super low rate to a high or normal rate in 1 year, that's obviously very problematic for banks because a lot of them locked in loans to securities at lower rates. And then when you have like in basis point terms, the Fed's move is the biggest since like the 70s. And on a percentage terms, it's the biggest ever, going from zero rates as high as they did, as quickly as they did on a year-over-year basis. That's basically the biggest 1 year move that we have, and I think that's somewhat disruptive. So I would describe it as basically that there's a difference between the end state versus getting there. And if you try to get there too quickly, that's obviously very bad for banks. It also depends on what bank, right? Because going back to the prior discussion, it's not as bad for the big banks. I mean, they can face some disruptions. Obviously, some of their loan books are not in great shape, but it's really bad for the long tail of smaller banks because they're the ones that are under more deposit pressure, or that can face more random liquidity runs that hurt their ability to run themselves.
Lyn, what I like about your framework is you're not just macro, you also look at individual companies. And I know that you've analyzed individual banks. I think the big, large banks, as well as the regionals. Does this recent bout of turmoil and the fact that deposits are moving from regional banks to large banks and may continue to do so, does that make you more cautious on investing in regionals, more optimistic about investing in the large banks, or more pessimistic about both?
I think this whole thing kind of brought down the average base case for what the banking sector is going to look like, but it changed the large and the large regionals. So basically the money center banks and the large regionals, they are less impacted overall than the long tail of small and medium-sized banks. Because if you look at those large ones, some of them do have significant unrealized loan books, but they're in a much less likely probability of having to realize those losses than those smaller ones. That was even before the Fed facility, but now with that new Fed facility, there's even more defense against them having to realize those losses. But any bank up to, maybe not the top ones, but any bank is subject to deposit pools. And even if they have access to the Fed facility, that's still a higher rate than they get with deposits. So it still impair their profitability. So I think the overall space is less attractive, but it's already been rapidly repriced for that less attractive world. And so I'm not particularly pessimistic on, say, the top 10 banks, even though I am, quite concerned about, say, that the long tail of the smaller banks.
And let's explore that Fed facility that was announced on Sunday, where the Federal Reserve will lend on a lengthy basis up to 1 year against investment securities that banks own. And by the way, lend against them at par. So if a bank bought a Fannie Mae security at $100 and now it's trading at $80, the Fed won't lend them $80; they'll lend them $100. How effective do you think this will be in helping bank solvency, liquidity, profitability, what we've been talking about?
So I think it helps with liquidity more than it helps with solvency. I mean, banks, if they have huge unrealized losses relative to their capital, that's still going to be a challenging time to deal with for the next, few years, because they have to manage their liability rates compared to their asset rates. Whereas for banks, where it's purely a liquidity problem, that can be quite helpful to them to reduce their tail risk associated with a large deposit pullout on a quick basis if their solvency is fine. So I do think it reduces risk for especially the large and liquid banks. As for setting a precedent, I keep bringing up the 1940s, and when you have a period of financial repression, banks essentially become utilities, and it's really offensive to kind of our capitalist view of the world. But that's kind of the incentive structure they've set up when they've gotten in such a high debt position. So, a lot of people are treating this like the 1970s, where, okay, there's inflation, let's raise rates. Whereas in many cases, this is more like the 1940s, because we have fiscal driven inflation, we have very high debt levels. And so it's hard to use monetary policy, higher rates, and tightening the monetary base as an effective tool against that. And so I think a lot of the things that people are surprised by with these sorts of actions that, kind of in some way socialize the banking system, I think that's kind of the base case this decade, unfortunately. I think that's the direction they've kind of set themselves up for by designing the system as they have.
Another belief I'd like to explore is the saying that the Federal Reserve will hike rates, the Federal Reserve will tighten monetary policy until something breaks. Has something broken? Is this the turning point?
I do think this represents breakage. We saw cracks last year with, in the autumn of last year, the Treasury market was getting quite illiquid, and then of course the UK, the gilt market did break. They had to do some intervention. From there we saw basically a weaker dollar. There was kind of also the Treasury general account was offsetting some of the Fed quantitative tightening, so a lot of measures of domestic liquidity started trending sideways, and that kind of represented sort of a line in the sand. And in recent months, as we've kind of gotten back down closer to that sand, we did see this start to break. And so I do think in many ways, they've reached their point where it's hard to get much tighter than this. Now it's currently not hitting the Treasury market. So if they want to tighten further, they technically could. It would come with probably a lot of bank problems, and probably heighten the probability of recession. So it's not like it's an emergency where they have to stop right away. But I do think that for most practical purposes, any attempts to further, say, draw liquidity out of bank reserves is probably going to result in more usage of those types of liquidity facilities, and therefore offset some of their liquidity pull. And then whether or not they want to keep raising rates partially comes down to whether or not they want to really hurt that long tail of smaller and less liquid banks. And so I think that the end game was always going to be, um, when you have debt this high and when you have a financial repression scenario, is that inflation is going to run higher than rates for a long period of time. And the question always was, what is the path to get there? And what is the order of things breaking? And A lot of people are looking for credit events, which I still think there might be credit events, especially in say commercial real estate. But credit events are largely not the problem. It's about basically liquidity. Sovereign debt. That was like I said, the issue last year, and then this time it turned out in the banking system. So I do think they're at the point where it's harder to keep tightening beyond what they've already done, despite the fact that I think inflation is going to be a recurring problem. Maybe not a problem this year. We'll see what happens with ongoing energy and China reopening and things like that. But I do think it's probably going to be a recurring problem, and that it's really not something that monetary policy can address effectively, because it's more about the fiscal issues and the real world issues throughout the economy.
I think it's a really important point you made that you can't compare prior crises. And 2008 was all about credit risk. And this period, at least so far, is not. There are two risks that fixed income investors, if you're lending someone money, face. Number one, credit risk, they won't pay you back. Number two, you will be paid back, but the cash flows you'll be paid back with are worth less because interest rates have risen, or they're worth more because interest rates have fallen. And I'd like to just put up a chart from Lyn Alden Investment Strategy, showing a chart that looks like apparently safe. This is a chart of uh, cash and treasuries on bank balance sheets as a percentage of total assets. So it reached a bottom right before 2008. So banks had very low levels of liquid cash, and that was a huge problem. And their credit loans went bad. But since then, it has exploded higher. So banks have lots of money. They have cash, they have treasuries. So I ask you, Lyn, what's the problem?
The problem is it comes down to that liquidity, that basically some of those treasuries, as well as other agency securities, are underwater because interest rates have gone up so quickly. And so basically the problem in 2008 was banks were super aggressive with their lending standards. They lent into subprime. They were very heavily focused on real estate. They were just, loose underwriting standards, and they had very, very little, risk-free assets, things like cash and treasuries. Whereas now, that's not the problem. They have plenty of very riskless types of assets, and they've been pretty good overall with their lending standards. The problem is just the sheer speed with which rates increased put a lot of their safe assets underwater, which again is somewhat fine as long as they can hold to maturity, which the larger and more liquid banks are far more likely to be able to do, compared to either the small banks or ones like Silicon Valley Bank, where they had a very unusual deposit base, where it's almost all businesses. They're almost all their deposits are uninsured, so they have a higher incentive to want to flee should there be any sign of a problem. Um, and so I think to the extent that this matters, it's very much bank dependent. And ironically, in 2008, for example, there were some banks that were just completely unharmed by it. They never got into the weird lending behavior that some of the large banks did. And so there are a number of small and medium sized banks that just continued functioning because they never engaged in that type of behavior. Whereas here, in some cases, it's the opposite. Basically, the larger banks are in many ways better positioned, whereas those smaller banks are the ones that are under more pressure. Again, not because they necessarily did anything wrong. I mean, some banks did, but a lot of these like small and medium-sized banks, they kind of operated the same way they're always supposed to, and just it's a very hard environment to have that speed of rate increases and simultaneously decreasing liquidity in the system. Doing quantitative tightening, shrinking the monetary base, all this happening at once puts a ton of pressure on that long tail of smaller banks. It's kind of like, the way the Fed currently works. It's like if you're gonna screw in a screw, and it's like for them, instead of like turning the screw, they're turning the whole world. And that's what happens when you're like rapidly increasing or decreasing the size of the monetary base of the country. It's like basically, banks are trying to do their job, and it's like the whole world's moving around them, and it makes it very hard to do their job. And of course, there's some that are better at risk management than others, but it doesn't change the fact that it's just a hard environment to operate in, even if you have overall good lending standards and risk management.
So for risk management, there's credit risk and interest rate risk. So credit risk is something that regulators are very concerned about. Lots of regulation. Everyone's got out a magnifying glass. Are they going to pay back? Are they going to pay back? And Silicon Valley Bank actually, I believe, I mean, I've looked into this. They had pretty good loans. I mean, they lent to venture capital funds and companies. They lent against portfolios, so for capital calls. So their loans actually had a very low default rate historically. But then now we're going to put up this chart. So the problem was not credit risk; it was interest rate risk. And this chart is the bank losses on their securities, which is vast majority due to interest rate risk. And can you just explain why the Federal Reserve raising rates from 0% to 4%? I mean, why did that? Doesn't sound like it hurts anyone. Like, why are we seeing such extreme losses of, 500, 600, 700 billion dollars of unrealized losses on the bank balance sheets? And how's that connected to the Fed raising rates?
So if you buy a 10-year Treasury note that yields 1.5%, and then higher inflation and higher interest rates come, and now that's yielding 4%. Basically, if you were to sell that onto the market, no one's going to buy it for a 1.5% yield when they can buy current treasuries with a 4% yield, whatever the number happens to be that time. And so what happens is the older, lower yielding security has to be discounted in price so that it has the same yield to maturity as these newer, higher yielding ones do. And so a lot of those are marked down by, say 20%, for example, in order to adjust to the current rate. Now, that doesn't change the fact that if you hold that treasury till maturity, you're going to get the full amount back. But it does mean in the meantime, you're holding this thing at a loss. And if your funding gets pulled, right, like if you're using liquid depositor money and it gets pulled, then you have to sell that for the loss and realize the loss. And some banks, if they got way too into duration, like Silicon Valley Bank, for example, the stimulus from the Fed flooded the system with deposits in 2020 and 2021. Tons of new deposits came in. Banks had to put them somewhere. And if you put them into shorter duration assets, you're generally in a pretty good position now. Whereas if you put them primarily into long duration assets, 2022 was like the worst year ever for long duration treasuries. It was like the worst year in like modern history. And so if a bank was overexposed, basically bad risk management, overexposed to duration, they can have these unrealized losses that come close to or exceed their amount of bank capital, which makes them more exposed. Whereas other ones that are more diversified, they're sitting on unrealized losses, but they're smaller than their amount of capital, and they have a more diverse deposit base, and so they're less likely to have to sell at a loss. And then even if they do, it's less likely to sink the whole bank.
If you've been listening to Forward Guidance, you probably know that US Treasury yields surged higher last year. Right now, you can get a 4.8% yield on your cash with Treasury bills. That's pretty good. It's even better than what you get with a traditional high yield savings account. So owning US Treasuries is great, but buying US Treasuries is super complicated, or at least it was. You used to have to go to a bank or navigate a government website that looked like it was designed in the 90s. Thankfully, investing platform public.com has changed all that with the launch of Treasury accounts. Now you can move your cash into US Treasuries right from your phone. And you can do it with the flexibility of a bank account. There are no minimum hold periods or settlement delays. In other words, you can access your cash whenever you want. And the best part is that because it's government-backed Treasury bills, it's an incredibly safe place to park your cash. Public will even automatically reinvest your Treasury bills at maturity, so you don't have to do anything to continue growing your yield. So to get that 4.8% on your cash, go to public.com/forward guidance to move your cash into a Treasury account today. Thank you, and let's get back to the episode. Do you think Silicon Valley Bank would have made it if the Federal Reserve facility, the BTFP, had already been in place?
I mean, it's possible they could have potentially sold them. I mean, they could have like loaned them out instead of had to sell them and realize that loss. Their particular case, though, they had such significant unrealized losses relative to their capital, um, that they're kind of an outlier case. So I do think this facility prevents other banks from having a similar issue. I'm not sure it would have been enough to help there. I think that question will largely depend on how long rates stay at these levels. Because if you have that significant of unrealized losses relative to your capital for a prolonged period of time, and you start relying on those facilities, then your funding costs start going up, and so that starts to present a significant profitability problem So it certainly could have helped them in the near term, but it still would have raised questions about their long-term viability, given that they made such a big bet on duration.
And they're not the only one. Bank of America, and again, this is stated because it's got a huge bank, but I think they've got over $100 billion of unrealized securities losses on their portfolio, and money is flowing in. They have a incredibly low percentage of uninsured depositors as a percentage of the deposit base, and there are many reasons why Bank of America is going to make it. But let's say there's a parallel world where Bank of America doesn't have over $100 billion of unrealized losses. What's different in this world? Is Bank of America going to be more cautious about making loans?
Well, I think partially it's going to come down to being more conservative with lending, as well as things like dividends and share buybacks, because you want to have plenty of capital on hand to withstand any sort of liquidity shocks or unrealized losses relative to your capital. I think in some ways it could be a profitability sink for a period of time. The large banks, basically, if you think of the deposit base as like a bunch of cups of water, it's really hard to pull all that water out, right? I mean, there's only so many places it can go into. And so it's not like deposits can all just flow out of, say, JP Morgan, Bank of America, and just flow out of the whole system and crush all the system. Instead, it's like, some deposits can leak out into things like money markets and treasuries. But most of the deposits are kind of sticky, and they can shift around. And so for any smaller bank is vulnerable, but those like big four banks that each one is a pretty significant percentage of total deposits, it's really hard for that scale of deposit to flow out unless that bank had such a severe problem that it was extremely warranted. So I don't really view the big four banks, including Bank of America, as a solvency risk here. We also I don't know Bank of America's full hedging position. I would imagine that they hedge some of that duration risk better than Silicon Valley Bank. But even if they didn't, their losses are smaller than their total capital. So it's not as severe as Silicon Valley Bank. Plus, they've just a way less skittish depositor base, because of one, their size, and two, the types of clients that they accept. And so I do think we'll see generally more conservative behavior among banks going forward. But again, it wasn't, this wasn't really caused by bad bank lending decisions. The risk that somebody's made was a bet on duration, which is in a more understandable risk, I think.
Absolutely. And one chart we can put up now, excuse me, is just the time when banks bought a lot of these securities, when the 30-year mortgage rate was very low, when the 10-year treasury rate was very low. And as interest rates rose, that is when they have a lot of those losses. So, Lyn, so far we've talked a lot about the asset side. Now let's talk about the liability side. As I mentioned, Bank of America, vast majority of depositors are insured, so they really should have no reason there to withdraw their money. They're under the limit. I think Silicon Valley Bank at year end, 87% of deposits were uninsured. They're banked businesses, and this was a very stable business model over the past decade because interest rates were at zero. So, oh yeah, who cares? 0%, 0.15%. It's my bank. I trust my bank. Do you think that there are going to be more outflows? And yeah, I mean, like, do you think that there are only two dominoes to fall? Number one, Silicon Valley Bank, and number two, Signature Bank, or do you think there are going to be some bank panics that may not be systemic, but this is something we should expect?
I think there could be more out there in the smaller bank land because, a lot of those don't have significant security books. They have a lot of illiquid loans, and they might be high quality loans. I think a lot of them are high quality loans. But if they face a bank run for any reason, they could run into severe liquidity problems, and they can't really use that facility. And so they could either fold, or they could rely on high cost funding to get them through that. And so I think both the profitability and the liquidity of some of the smaller banks are going to be challenged for a while. It also largely comes down to a decision by the Fed. To what extent, now they have a clear trade-off between raising rates versus keeping the banking system somewhat stable. The higher or the longer that they hold rates here, the more it kind of drags deposit rates up to their current level of interest. And that's fine for the big banks because one is everybody wants an account there, so they're less quick to raise their rates. Um, Whereas like the smaller banks, if they have to raise their deposit rates, then this liquidity problem starts becoming a profitability problem. And if a profitability problem gets bad enough, it can become a solvency problem, right? I mean, if basically liabilities start paying higher rates than assets, and if that is going to persist for a while, then the bank's in trouble. The ironic thing is we actually see that among central banks. They're just lucky because they can't have bank runs, and can't go bankrupt. So the Federal Reserve right now, for example, um, their liability side, they made the decision to raise those rates significantly, whereas they're actually holding long duration assets. They're holding treasuries and mortgage-backed securities. So I mean, I think the overall unrealized Fed losses were like something like $1 trillion at the peak. Probably now it's hundreds and hundreds of billions. Whereas even their operating profit has turned into an operating loss and that kind of shows what happens if you actually do raise your deposit rate super high while you're holding um, you know low yielding assets, right? So it's obviously a severe case because most deposit rates won't go up that quickly relative to what the Fed's liability side did. But that's kind of an example of what can happen if deposit rates keep grinding up at a quick rate.
So do you think that rate hikes are going to be over? Do you think it's one more next week at the FOMC meeting and then it's over? How long do you think they can continue to do quantitative tightening? And where do you think Fed policy is, let's say in 1 year on March 15th of 2024? And by the way, it might be the 1 year anniversary of the Fed raising rates on March 15th, 2022. I don't know about that. But yeah.
I wouldn't be surprised if they hold uh, flat this month, or if they go 25. I'd be surprised if they go any above that. I think it'll partially depend on what happens the next couple days. I mean, we're watching Europe have significant problems now, so some of this is contagious. As for betting a year in the future, I mean, at that point, you're betting on human decisions. So in some ways, you're looking at numbers, but you're also betting on human decisions relative to those numbers. So I think a general framework investors have to have is that this decade, it's going to be very hard to have positive real rates and any sort of normalized persistent basis. There might be brief periods of time, especially in recessions, where you get to positive real rates. But the idea that we're just going to go back to like this long period of positive real rates like we had in the 80s and the 90s, for example, I think that's not going to happen. And the problem is that interest rates are, I think, going to be increasingly politicized. Right. So now that the Fed is unprofitable, now that small and medium-sized banks are pressured, um, we saw, for example, in Congress the other day. I mean, Elizabeth Warren was questioning Jerome Powell and basically saying, like, what are you going to say to the 2 million Americans that you're projecting you're going to put under work with your rate hikes? Basically, in these types of financial pressure scenarios, um, interest rates become very politicized. So if you look back in the 70s and 80s, Jimmy Carter put Volcker in. Um, and that arguably that hurt his reelection chances, but he viewed it as an important thing to do for stability. And then Reagan also let Volcker continue doing what he was doing. And so for a long stretch of presidents, both Democratic and Republican, you had a high degree of independence where they didn't really kind of question central bank decisions as much. Whereas you started seeing under Trump, he was not happy with Jerome Powell raising rates. And now you're seeing it from, even though Biden hasn't really gone that route, you've seen it among, Democrats in Congress, where they've questioned Jerome Powell's roots. And so I think a challenge is that both over the next year and longer term, monetary policy in many ways becomes politicized. The Fed essentially becomes the fourth branch of governments. And so it's hard to predict all out. But I think the baseline assumption or the baseline math, the way that it kind of works out, is that rates are going to spend most of their time submerged below inflation, with perhaps brief exceptions during disinflationary shocks.
There was an argument that was gaining a lot of credibility earlier this year, which is that the US economy is much less sensitive to interest rate hikes than previously imagined. The Treasury borrowed at, a 6-year duration, 7-year duration. The U.S. consumer borrowed, as long as a 30-year mortgage rate, and that, the argument of, oh, rates can't go high because the government can't afford it, U.S. consumers can't afford it. Oh, banks actually will benefit from it. It's a little ironic that banks were actually sort of the first one to fall. Do you, and that's because their liabilities, in many cases deposits, are instant. They have to, fork over the money. But what do you think about the governments and U.S. corporations, which you'll borrow at 20-year, issue a 20-year bond, or some people who have a 30-year mortgage, who might be a little more immune from high interest rates than the banks?
So on a corporation basis, it really varies on the company. I mean, I look at some of these energy pipelines, for example, and some of them have like 20-year average duration, fixed rate, low yielding debt, and so they're sitting pretty well. They're rather protected against interest rate increases. Um, Obviously, some more troubled companies don't have that kind of luxury, so it's a little harder for companies with more credit risk. But the average healthy kind of blue chip company is actually pretty well positioned. Their debt is pretty long duration and submerged below the inflation rate, so they're not really complaining. Also, the U.S. consumer has more fixed rate debt as a ratio compared to a lot of other countries. So in many cases, that argument that we're more protected from interest rate increases is true. Now, as you've seen with the long tail of smaller banks, that's obviously not true for the banks. Especially if you raise rates this quickly, right? The sheer speed of rate increases combined with pulling liquidity out of the system has pressured the banks. So that's a breaking point. And then two, it also reduces everybody's mobility. So they might not be underwater with their home, but they also can't move.
Mm,
And you also have trouble, building new homes. Basically, all that kind of whole segment has frozen up, and then also you get problems in commercial real estate. So really the two sensitive sectors to interest rates are, one, obviously real estate, because it's so debt focused, and then two, tech. And that's because if for a long time there's a kind of the assumption of just zero yields and money's cheap, so hold anything other than money. And so people monetize equity, right? They're willing to pay these super high multiples. And so the company doesn't have to worry about being profitable. They can just keep issuing equity to employees and shareholders and investors. And then that allows them to grow quicker because they're underpricing their product or service. But if you then get a real cost of capital, um, it crushes their equity valuations, so they can't rely on constant equity issuance, so they have to raise their prices to try to be more profitable. That then reduces their growth rate. You kind of realize that their prior growth rate was in large part an illusion based on mispricing. And so the overall addressable market of those growth companies, those tech companies, as well as their appropriate valuation, is now much reduced. And then you get slower, you get layoffs, you get slower employment activity. And so really real estate and tech are highly sensitive. The people's mobility is highly sensitive. And now that we've seen that, outside of the large banks, a lot of banks are vulnerable to these rate hikes. And so I think in general, um, that's where you get a challenge in raising rates, even though inflation is an ongoing concern. And then as far as the Treasury is concerned, even though their average duration is like 5 or 6 years, it's kind of skewed, right? So something like half of their debt is really short term, and then the other half is like spread out over a variety of durations. Um, and so even though their average is 5 or 6, I mean, really, it's a lot of it is in the first few years. Um, and a challenge is that, in the 1970s, a lot of the money supply growth, the majority of it was from bank lending. That's because you had peak demographics, baby boomers were entering their home buying years. And so a lot of monetary policy was focused on slowing down that lending growth, especially because we also had a, oil supply side problem. Whereas the inflation you saw in the 1940s and the inflation you saw in the 2020s was not because of excessive bank lending. So banks didn't lend much in the 1940s. Banks were not lending excessively over the past decade, including over the past couple of years. And instead, the inflation was largely because of very, very large fiscal deficits. They were just flooding money into the private sector. And the ironic thing is that increasing interest rates results in larger deficits. So even though it can, in the near term, reduce economic activity and reduce inflation by squeezing the private sector, it also exaggerates the ongoing source of money creation, which is the federal government. And basically, if you squeeze banks hard enough, and they have to start getting rid of their securities to support their deposit base, then who becomes the buyer of treasuries? And so I think that if you were to squeeze the banking sector hard enough, that eventually gets pushed into the sovereign level, and that's where they have to reverse. And so the question is, will they try to push it that hard, or will they start kind of slowing down now? And I think that the answer is they're probably going to start slowing down now, especially because the more they try to tighten, probably the more you'll see usage of these liquidity facilities.
I want to ask you about government deficits, debt, and the degree to which they're unsustainable. After the great financial crisis, when the U.S. As a stimulus measure ran a significant deficit, which at the time was considered huge, relevant to now it's not huge. There are a lot of people saying, "Oh, debt as a percentage of GDP, it's unsustainable." Recently, a school of thought called MMT, modern monetary theory, is that debt itself, whether it's large, whether it's small, it's always sustainable. A government that prints its own currency can always pay its bills because if I owe 10,000 Jack Farley bucks, I'll just print 10,000 Jack Farley bucks. I don't think I've ever asked you about modern monetary theory, and so the central premise of one of the central premises of modern monetary theory is that the limiting factor is inflation. If inflation is low, like for example it is in China, the amount of money printing that the Chinese government can do is unlimited up until the point that inflation becomes a problem, and then borrowing costs can increase. But on a very philosophical, non-practical level, do you agree or disagree with that premise? And then we can get into the specifics on the debt ceiling and everything.
So a government that prints its own currency can't default nominally unless it chooses to. It can always print the difference. It can always control its central bank to print the difference. And so that's why you rarely see sovereign defaults when priced in their own currency. Instead, you usually kill the debt through inflation. Basically, if debts are super high relative to income and economic output, those debts are going to lose purchasing power one way or another. It could be from default, it could be from restructuring, or it could be through inflation. Um, and the MMT description of how that works, I think, is accurate. But I think the real world challenges that because if you look at MMT, essentially the argument there is instead of using monetary policy to control inflation, you use fiscal policy. And so if inflation's low, they basically argue that there's more room for deficit spending to put more money into the economy. And if inflation's high, then you have to pull back on the deficit spending. The problem is the real world is politically gridlocked, right? Have like basically if you go to an MMT right now, like Mosler, they would say, okay, just cut fiscal deficits. Like, well, good luck, because on one hand, they're not going to cut entitlement spending. It's very politically unpopular to do that. The Democrats certainly won't. And for example, one way that former President Trump, separated himself from the rest of the Republican Party is that he's not in favor of cutting a lot of these, whereas you've generally seen some interest in cutting them among the Republican Party. So there's really large wings of politicians that don't want to cut those. There's also, what is it, like $850 billion in military spending at a time when Russia is doing what they're doing. That's not going to get cut. The military industrial complex is big and alive, and now has a new catalyst to cite. So that's not going to be trimmed. And then Republicans are very opposed to increasing taxes. And so there's gridlock on multiple sides about all the angles that could be used to rein in the deficit. And then ironically, at this stage, because the economy is so financialized, even if you did try to reduce the deficit, you probably would get less tax revenue because you'd have asset prices do very poorly. And so you probably end up ironically widening the deficit from that angle. So it's actually very, very challenging to reduce the deficit and therefore rein in inflation. And so the part that I think is somewhat correct out of modern monetary theories currently is that they point out that raising rates can actually exacerbate inflation, and that's because you have a very fiscal driven inflation. So that's the part where I would agree with them on. But if you look at their proposals, they say, okay, we'll cut rates to zero. It's like, well, I mean, if inflation's running that hot and there's that much fiscal stimulus, and you cut rates to zero, then it encourages massive borrowing. People should buy money and buy almost anything else, right? If Turkey cuts rates to zero, what should you do? You should borrow lira and buy almost anything that's not lira, right? And then, so that's why normally in these types of high debt scenarios, that's why you get capital controls and financial repression, because the answer of raising rates doesn't work, and the answer of holding rates low doesn't work. Because if you raise rates too high, you exacerbate fiscal driven inflation. And if you cut rates low, you encourage massive money creation through borrowing, because the currency is not keeping up with inflation. And so normally what they do is they try to end up holding rates low, but then blocking various things that you can borrow money to buy. So for example, Turkey has imposed restrictions on corporations, say borrowing lira to buy foreign currency, for example. Um, uh, that's common. I mean, in the United States, for example, in the 1940s, the 30s through the 70s, it was legal to own gold. And there's all sorts of other kind of just restrictions on the ability to capital to move around globally. It gets kind of siloed, and so I think that's kind of the scenario that is a risk going forward, is that neither high interest rates nor low interest rates are a solution to what is largely a structural deficit problem.
Can you explain the theory that high interest rates can actually exacerbate fiscal inflation? Because I think the mainstream belief is that high interest rates fight inflation, and that's why the Federal Reserve has raised interest rates so much over the past year.
If we back up for a second, there's really three ways to make broad money. One is bank lending. So when banks make loans, they make deposits. Two is if QE happens, and they buy assets from non-banks specifically. That can increase the broad money supply. That's generally not a huge factor. And then three, if there's large fiscal deficits that are then monetized by either the central bank or the banking system, that increases broad money supply. And when you have excessive money creation through either excessive bank lending or excessive fiscal deficits, that can be quite inflationary over a long period of time. And so in the 1970s, most of the money creation was bank lending. So raising interest rates to slow down that bank lending made sense. Whereas in the 1940s and the 2020s, it's not excessive bank lending; it's excessive deficits that's pouring more money into the economy, pouring, just basically, if you flip it around, those deficits are a stimulus. Those are surplus for the economy, which is bad if you have inflation, right? It's just more money pouring into the system. Um, and right, so for periods of time, the Fed can tighten, right? So by raising rates, by reducing their balance sheet, they put pressure on the private sector, which is somewhat offsetting the public sector. But that public sector has, like, the next like 5, 10, 15 years is nothing but deficits. And it's just nothing but growing deficits. So if you squeeze the private sector for a year or two, that doesn't change the fact that you have this structural backdrop of inflation. And then ironically, what it does is if you increase interest rates, like let's say we just jack up to 10%, this is, go super high, like the Taylor rule says we should do. Well, then those fiscal deficits are going to get even bigger. And when you
Mhm.
have gridlock around what to do about it, you're not going to cut entitlements, you're not going to cut military spending, you're not going to materially raise taxes most likely, unless you had a massive change in the voter base and politicians. So those deficits just get bigger, and it's actually just more money pouring into the economy. Um, and so that's why people often, I think, are too simplistic. They say, well, if inflation's too high, then raise rates. If inflation's too low, then cut rates. Whereas really you have to go deeper and you have to ask, what is the source of money creation and what would exacerbate that or slow that down? And that's why it's a really hard problem when you have fiscal, at least in the 1940s, the fiscal driven inflation had an end date, which was the war, and the immediate rebuilding is over. And so you can get back to a period of austerity and get inflation under control. They basically, they inflated a lot of the debt away, but then they were able to stabilize. Whereas the challenge now is that there's no war that's about to end. You know, Even if, say, the actual war ends, that's not really the current source of money creation. It's basically the entitlement we've built up over decades. And so I think that's an ongoing structural issue, and interest rates don't really address it, and in many cases can make it worse.
I see. So the argument of raising rates, independent of the effect on the consumer, if interest rates are at 10%, the government will borrow less money because it's incentivized to borrow less money. It will have to run a surplus. If they don't do though, and they keep the deficit at the same level, they're just paying more money out. And so now instead of people who own bonds getting 2%, now they get 10%. So that's an argument I've seen Warren Mosler discuss, but I actually never really understood it until you said
And
that. So
and
thank
that's a key insight that I think you phrased it well, that the private sector is market driven, and so they're incentivized by rate, especially real rates, on whether or not to like borrow or not, whereas the government really isn't. A lot of this is locked in and gridlocked, right? So whether rates are 0 or 10% or anywhere in between, it's not going to materially affect fiscal decisions over the next few years. And that's why those interest rate increases are not really the most effective tool against inflation and can actually exacerbate it. And I think the challenge is that you can get like a year where it seems like it's working, like recently, because you say, well, I mean, you were raising rates, inflation's coming off, and it's like, well, yeah, because we're pushing the economy towards recession. We're squeezing parts of the private sector, which is fine, but the problem is that's inherently a temporary thing. The Fed can't do QT for the next 3 years. They can't raise rates to 10%. There's all sorts of things they can't do. Meanwhile, those fiscal deficits are still flowing.
Right. And base effects that you talked about, if the price of oil is at $120 in June of 2022, if it stays at $120, which is ridiculously expensive, inflation will be zero. So headline inflation relying on food and energy, that has been declining. And that gave the disinflationistas a lot of confidence coming in from, let's say, October to January. And that, to some degree is responsible for the rally in all risk assets during that time period. Do you think that was a false signal of disinflation? And what do you think about the recent inflation readings, particularly core inflation?
I don't think it's false. I just think it's temporary. If you look back in the 40s and the 70s, inflation came in waves. There are periods of fighting back, either price and wage controls or central bank trying to tighten things up. And so, once it was clear last year that the Fed was, aggressively tightening, my stance shifted towards, okay, structural inflation but temporary disinflation. Um, and then it became a question of how deep are they going to try to push it. Um, and I think the recent episodes show it's really hard to push it all the way back down. The energy currently is under control, but labor is really not so much. One thing that kind of I think complicates the data is that the shelter component of CPI operates on a lag. So early on in the inflation spike, that actually understated how much inflation was happening because home prices and rent prices were higher than shelter CPI. Whereas now, shelter CPI is still grinding higher, while a lot of those other the actual things we're paying have already kind of flatlined or in some cases contracted a little bit. So I think usually CPI will understate inflation, but ironically during kind of brief disinflationary periods, it can actually overstate inflation temporarily. So I still think we're in a somewhat disinflationary window. Obviously, one of the big questions was how much is China reopening, right? When we're trying to, reduce energy prices and things like that, how much is that going to be impactful? So far, that's been overridden by some of these other forces. We'll see what happens when they really get into full gear, maybe later this year. So I don't really have a firm view on what happens with inflation over, say, a 6-month period. Instead, my high conviction view is that as long as the sources of inflation are still there, which is very large fiscal deficits and real world constraints on energy and infrastructure and real world stuff, that's as long as those two pieces are in place, that's a structurally inflationary backdrop. And the best we can do is temporarily rein it in, probably at the cost of a recession. And then when you try to accelerate out of the recession, all those forces still there, inflation comes right back because the tools that we're using to address inflation are not actually addressing the core underlying problem.
In 2022, many were worried about a recession. You saw some risk, but you said, "Oh, I think the economy will be resilient. I think that the economy can take it. The economy can be strong." And for the most part, you have been proven right. What about now? I see in your most recent note on Lyn Alden investment strategy, you were saying there's some recession risk. How are you thinking about this? And as well, the bond market, a massive bull steepening, short-term interest rates going, flying down. Uh, is the bond market telling us a recession is coming? I know the bond market was so wrong in 2021, but is there a chance it's right now?
So I think overall, basically, the way I would describe the economy over the past year is that it's decelerating, but it's been hanging in there, and it's in large part because there's so much money in the system, and so it was looking more recession-like without actually being a recession. Um, this recent issue with the banks, actually in some ways both adds a catalyst in both directions. So on one hand, if this ends up being the ceiling for overall Fed tightening, roughly speaking, um, and liquidity floods back into the market, that can actually be attractive for the economy. So, for example, if you look back at the repo spike of 2019, in that few months that it happened after that, in addition to getting rebounding in asset prices, you actually had a minor rebound in economic indicators because you had more liquidity kind of entering the market. You had the dollar come off. You had a number of things like that that were good for not just financial assets but actually real economic indicators. Obviously, that got killed by the COVID crash, but for that kind of brief window, that's what was happening. So it's possible that you get like a brief window here where liquidity, kind of kind of presents like a bottoming in liquidity, and you have a decent period of time. On the other hand, it's largely going to depend on bank behavior, right? So if banks really tighten up here, which it looks like they might, then they might be able to override that liquidity. And so the way I would describe it is that I think the general direction is towards recession. um, I I doubt it'll be as severe as some people are concerned with. I think it might be kind of like the post.com bubble recession, which was actually in many ways the mildest recession, of many recessions before or after it. But again, it largely depends on human decisions. This is an actively managed system, and so it depends on what the humans at the helm do of it. I think there are a number of sectors that are resilient, things like healthcare, energy pipelines. I think that there are a number of spaces that are interesting. Whereas I think commercial real estate, I wouldn't really touch that. Unprofitable tech, I'd be highly selective with what I'm interested in touching there. But I think other parts of the economy are fairly resilient, and it just depends on how much we want to do policy mistakes to see if we can disrupt that resiliency.
Mm. So you think the Fed might be nearing a pause. So that means short-term interest rates probably will fall more, but then you're also a structural inflationist. So longer-term interest rates on the margin could go up. So is it safe to say that you think the yield curve will steepen or actually get less negative? Like now it's, well, a week ago it was 80 basis points and now it's probably, I don't know, 50, 60, I don't know. But you think it will, get towards a real steep yield curve enough where banks can actually borrow short and lend long?
I think in the next 6 months, I'm honestly highly uncertain of the shape of the yield curve because there's so many human decisions that go into that. I think if more people, like if you look at break evens, the market does not expect long-term inflation, right? So if the market determines for one reason or another that long-term inflation is going to be a problem, then it very much might try to drive those long end yields higher. And then you could get some sort of situation like the UK ran into where they have to intervene in the long end of the curve to prevent a liquidity problem. Um, and so but I don't know if the market's going to realize that in 6 months, right? They could be more focused, perhaps rightly, on recession risk for a 6 month period. So um, I think it really depends on path dependence, right? And I think that in this kind of stage right here, I think we have to be honest with what we know and what we don't know. And I think the next 6 months are really unclear in that regard. Whereas I think the longer term picture is what's more clear.
Mm. So, Lynn, there are two periods of inflation over the past century, the 1970s and the 1940s. In the 1970s, interest rates, bond yields rose steadily with inflation. In the 1940s, they did not, in large part due to government policy. You think that the next decade will be a lot more like the 1940s. I know that in the 1970s, the stock market performed horribly. What did the stock market do in the 1940s?
It chopped around, much like the 70s. Basically, you had low valuations. I mean, obviously, you had a war going on, so people were not very bullish. It really kind of bottomed around when the United States started decisively winning over Japan. There were a handful of key naval battles that really, once those happened, it was basically a long grind towards a victory. And so the market kind of bottomed based on the war, right? So it's actually probably not a great signal for what to expect because it was moved around by that type of force. In general, if you have financial repression, so you have super low yields compared to what inflation's doing, that should be pretty good for a lot of types of equities. But it depends if there's other factors big enough to hold that down. A lot of times, if you look at emerging markets, and in many ways, this is like an emerging market style recession where you have high inflation and currency problems, but economic contraction. A lot of times you look at those, the stock prices don't do bad nominally in the local currency. They just do bad in dollar terms and basically harder currency. So I think in general, the stock market is unlikely to do well in purchasing power. I think we're basically probably looking at a lost decade in inflation adjusted S&P 500, for example. Now, I do think that there's value sectors that could do well. There's certain emerging market sectors that could do well. But I think that the large mega cap, American stock market is probably not very well positioned for a 5 to 10 year period, especially when you price it either in CPI or gold or whatever you want to do for your pricing that's somewhat kind of a harder measure.
Right, and that's your macro thesis. But I know from Lyn Alden investment strategy that you do like individual stocks in the mega cap growth sector. So there's always, it's a matter of underweighting. It's not taking it to zero. So you don't say, oh, because I think this might underperform, I'm going to short or something. And I think people watching that should do that too. Lyn, for final question, we've talked a lot about the investment universe, about the banking system. I want to say, tell us about the narrow bank. What is the narrow bank, and why is it significant?
Well, the narrow bank was proposed years ago. I believe it's a bank in Connecticut. But they essentially wanted a business model of taking deposit cash and putting it in the Fed. And there's been a number of other banks that try to do something similar. They're generally not allowed to do that. And essentially, if allowed to exist, it'd be among the safest banks you can have because it's essentially a full reserve bank where it's just kind of tied it right into the central bank. And that bank for depositors might be challenging in a low interest rate environment because they can't earn a yield. The bank can't earn a yield, and so they have to charge fees or some sort of way to stay in business for their customers. So it's essentially a bank for low risk depositors that don't want to take on any sort of default risk. On the other hand, if you have a higher rate environment where the central bank is actually paying out interest on reserves, then a type of bank like that can operate profitably and even pass on some interest rate to depositors, just lower than what they're getting from their central bank to cover their overhead. And so in general, there's, it's funny, basically banks are basically leveraged bond funds with payment services attached, and we treat it as totally normal to use this. It's like, where should grandma hold her money? In the highly leveraged bond fund. Like that's kind of how we treat it. And there's always been some people that want to do full reserve banking, and they've just generally not been allowed to operate because I think one of the risks there from kind of a policymaker perspective is if there's banks where all they do is give you direct access to essentially the central bank balance sheet, then why wouldn't a very large percentage of depositors want to go there, especially if it's a positive rate environment? They don't have to pay like a fee in order to have that exposure, and so you risk kind of sucking liquidity out from other banks into that vehicle. And so I think in some ways it shows how fragile the system is that they don't really want some of these safer banks to exist.
That's really interesting. And on an individual basis, it sounds bad. Oh, you're preventing people from being able to get 100% safe money, but expand it out to the society. If you deposit money in Wells Fargo lends that money, not that money, but money out to me, to a mortgage to buy a house. Let's say nope. Now sounds like you like the narrow bank. You take money out of Wells Fargo, go to the narrow bank. The narrow bank is not giving me a loan. It's not giving any loans. Is that bad for the economy? Does our current economic system, with its flaws and advantages, require bank lending? And would a world in which there's only one bank, the narrow bank, or many other narrow banks, would that be a completely different society? Would it be better or worse?
So yeah, I think there's two different answers depending on which direction we go. And I think it's not, it doesn't really work with the current system, which is really leverage focused. You basically have a constantly, depreciating currency unit and constantly increasing amount of credit in the system. It doesn't really work. It doesn't really vibe well with that approach. Whereas if I zoom out, I do think we could have a healthier economic and financial environment if we weren't so leverage based, if not everything was based around fractional reserve banking. So I obviously, I would generally incline towards that type of model. But as a realist, I think, in this period of time, it's just not something that's generally allowed, but it's something I would like to see in the future. And that's kind of what you see. I mean, obviously, there's been people in the gold space advocating for that type of thing. More recently, in the Bitcoin space, you have people that are anti fractional reserve banking. They're more like, just hold your own money. And I think that's an interesting direction to look in, and something that I don't really buy into the economic view that currency has to depreciate and that we have to use constantly increasing leverage. I think that's an artifact of this kind of past century and a half. And I'm not really sure that the next century and a half is going to look like that. But that's obviously, that's getting cosmic. That's like zooming
Yeah.
out. Whereas in this kind of near term, I don't think a full reserve direct line to the central bank is something that they would probably be interested in allowing, because it does disrupt the Wells Fargos of the world.
That's very, very interesting. Lyn, my final question for you is a cosmic one, which is, in a world without fractional reserve banking, who prints money?
Well, nobody. I mean, basically, if you have if you have a bunch of either free banks or full reserve banks, you probably have some sort of underlying hard unit that requires energy to produce. Back in the day, it used to be gold, for example. Nobody could print gold. Miners could expend energy to get more gold. And that's how new money is created. I mean, you still have credit in those systems, right? So I mean, there's still short-term funding needs, liquidity needs, and there's still, you can still kind of print claims on money. And so that comes down to individual lenders, as well as the government can borrow money. So you still have some degree of money printing when you count all those IOUs, but in that type of world, nobody can change the size of the monetary base. That's what's somewhat different. Or at least they can't freely change the size of the monetary base.
Mm, there we go. Lyn, it's been an absolute pleasure getting you back on Forward Guidance. Thank you so much for coming on. People can follow you on Twitter at Lyn Alden Contact, and your writings at Lyn Alden Investment Strategy are at lynalden.com. Thanks again, and thank you everyone for watching.
Thank you.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Check out today's sponsor, public.com, at public.com/forwardguidance. That's public.com/forwardguidance. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.